Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome back to the show. Hey, I think I've got a pretty good topic for you today. We're going to talk about how events affect the stock market. And I'd like to look at this from a short-term trading viewpoint rather than long-term buy and hold investing. And so let's take a look. We got several topics here. The first one is a thing called the Summer Doldrums. I don't know if you've ever heard of that phrase or not. It's kind of a common stock market phrase. What it means, every summer when you get into, it varies every summer, but I mean, usually around the middle of July and in August, all of a sudden the stock market just kind of goes flat. A lot of summers it does that. It just goes sideways. And you know, if your neighbor were to tell you how many ways that a stock market can go, what would they say? They would say up or down, correct? But there's really three ways. It can go up, down, or sideways. So it's doing that sideways move during the summer doldrums. And really, there's a really good explanation for why it does it. A lot of the Wall Street people are on vacation. And when they go on vacation, you know, the volume of trading just kind of goes down and not a lot's happening. And there's not as much news out there as far as business news or economic news and so forth. So it just kind of goes sideways. Now, what can you do? Is there a way to make money if it's not going up? Well, we know we can make money when the market's going down, right? We could buy puts or we could short the stock. But what when it's just moving sideways? What can we do? Well, there are things called spreads, and you can do a bull put spread or a bear call spread or something like that, and they actually make money going sideways. They make as much money if the stock went sideways as it would if the stock went up. And it can even make money when the stock moves down a little bit. And that would be a bull put spread. A bear call spread goes the other direction. Now, those types of strategies are kind of advanced. And so with TRADEway, you'd have to go beyond step 1 or even step 2 to get to those. It would be in step 3 and step 4, actually. And you can get there. It's great to know that. Otherwise, pretty much what you do in summer is you take a vacation, because you're just not going to be able to make money on short-term trades in the end of summer. Now, some summers, that's not the case. You can have big world events that happen, you know, like pandemics, things like that, that can make the market really volatile at the end of summer. But that's just the normal. If you go back and you look at the last 50 years, you know, I'm going to bet you 80%, don't hold me to that number, but probably 80% of the time, you get the summer doldrums and it just goes flat. So just remember, just for future reference, you want to take step 3 or 4 and access the ability to do the strategies of spreads. And they're pretty cool plays, but they're kind of advanced. All right, now the second thing I want to talk about is this idea. A lot of people have the idea that the big boys on Wall Street only buy, you know, big name stocks, blue chip stocks. And the reason people have that idea is because of a concept called window dressing. And what window dressing is that near the end of the year, a lot of the big mutual fund companies and different kinds of big boys out there, they will print a prospectus for their clients, and they want that to have blue chip stocks on it. So what do? They do a thing we call window dressing. And what they do is they go out and they sell these smaller companies that are known as growth stocks that make the money for them all year. They sell those and they buy blue chip stocks like IBM or something like that that's been around forever, maybe even Walmart, something like that. And they have these big name companies in the prospectus, and that's what you think your money was in all year. Now, so they do that usually in December, but when the holidays are over and you get into the first part of January, they sell those and they go back in and they start to buy little growth stocks. Now, these are smaller companies that are going to be the next Walmart or the next IBM. And they're newer companies that haven't spread out into the whole world yet, but will someday. And those are the great kind of stocks to trade in. And at TRADEway, we provide you a set of stocks, or you might call it a basket of growth stocks, usually around 100 of them. And they all have great fundamentals, and they're the right kind of stock to do short-term trading. They're growth stocks as opposed to value stocks. We have a program called the Insider Plus. You can go out to TRADEway.com and find that and access it. And it's going to give you some great things. It's going to give you fundamental analysis, technical analysis information. You can even set up your charting with what we call the David Mitchell settings, which has even support and resistance lines already drawn on all the stocks exactly the way that I draw them. And you have access to market alerts, which are emails that come daily, sometimes more than once a day, that talk about the market tone, how the world news or the economic news can affect your play. It also has industry rankings, some tutorials, and a lot of different educational things involved in the Insider Plus. But the main thing is you get that A-plus list. It's a basket full of about 100 of the best growth stocks in the world, and those are the best kind of stocks to be trading with short-term trades. They're way better than value stocks, and you'll learn more about the difference. But for now, just realize that's the right kind of stocks to be looking at. There's also another program you can find on TRADEway.com called Trader Max, which is really good because it includes everything in the Insider Plus. Plus, you get a ticket to a Step 1 and a Step 2, which are both live virtual events. Step 1 is the groundwork for everything you'll ever need to know about trading in the stock market. And Step 2 tells you how to leverage your money. How do you use options to make every dollar in your trading account worth $7 to $14 of power? And boy, it's fantastic. And for short-term trading, options is the way to go. So check out Trader Max at TRADEway.com. Now, when you know about what they're doing with window dressing, they're actually buying and selling some of the very stocks, or nearly all of the very stocks that are in what we call the A-plus list. That's a part of the Insider program. So it's kind of cool. You're actually looking at the stocks that these big boys are trading all year. And then, of course, those are the ones they tend to sell right before Christmas, and they do the window dressing and they go out and they buy the old blue chips. And just knowing that could help your trading. Think about it. If you know they may be going to sell some of the tech stocks, then you might not want to be buying tech stocks right at the end of the year. You might want to wait till the beginning of the new year when they start to sell the blue chips and jump back in those growth stocks. So keep that in mind. All right. So we talked about the summer doldrums. We talked about window dressing. Let's talk about another one. What about holidays? Let's take the big ones like Christmas, Thanksgiving, New Year's. What happens there? Well, I'll tell you, in my personal trading through the years that our family's been doing this for 3 generations, now 4, our family pretty much stops doing short-term trades before Thanksgiving, and we just don't trade until maybe the first or second week of January. So we don't trade through the Thanksgiving season and the Christmas season and even up to New Year's. And the reason for that, same thing about summer doldrums, only it's a little different effect. And that is that the big boys often are gone for Christmas or for Thanksgiving to spend time with their families. And so there's really, really low volume on all the stocks. And you don't really want to trade in an environment where you have really low volume, because that's just retail traders who really don't know what they're doing, and they can drive a market up that shouldn't be going up, or even drive one down that shouldn't be going down. And it's really hard to predict what the market's going to do. So my viewpoint is stop trading right before Thanksgiving and pick it back up about the second week of January. Skip those particular holidays. The other holidays don't have that much of an effect. So, some of the greatest traders in the world, what they do is they use that end of the year time to go back over every trade they did that year, look at the good things they did, the bad things they did, the things they need to improve on, and then build a plan for the next year. So I think that's the best thing to do during that time of the year. And also, you can review all the great things you've learned at TRADEway, review strategies, practice. You can do some paper trading and things like that during that time of the year. Okay, let's talk about another one. What about recessions? Well, most people think of that as a bear market crash. And it's true, most bear market crashes have recessions right as a part of the event. And so I think it's practically synonymous. But let me just give it from sort of a charting viewpoint. If you have a chart of the S&P 500, which is a really good index to chart because it pretty much represents the whole market, what the big market's doing. And what happens is you'll usually be in an uptrend, for several years. And then all of a sudden, the S&P chart will start to break down through some key moving averages. Now, moving averages are ways that you can set up these indicators on your computer. And if you go out to TRADEway.com and you become part of the Insider program, you'll actually learn how to do that. You can be part of the Trader Max program. It also will teach you how to do that. You can sign up for Step 1 Start Your Journey, which is a live virtual event you can take from the comfort of your own home, or you can do the Trade in 30 Days Challenge. Those are several ways that you can get access to how to chart the S&P 500. So what'll happen is it'll move down through, first of all, the 10-day moving average, and it may bounce up a day or two. Then it'll move all the way down through the 20-day, and then even down through the 50-day moving average. And you might ask, why do we use those? Our family's used them for years because we know that's what the big boys on Wall Street are looking at. So we're looking at the same thing they are, and we're teaching you to look at the same moving averages that they tend to look at. And so as the market moves down through those moving averages, especially when it closes below the 50-day moving average, and it can't move back up. If it bounces up a little bit one day and then heads on down further, then it can go to the 100 and 200-day moving averages. But even before it gets there, you can be looking at the news out there, both economic news and world news, because different things cause bear market crashes, and even different things cause recessions. So you should be seeing some really negative news out there also. Now, that's another cool thing about the Insider Plus is you get market alerts every day where my staff and I will tell you about the world events, both economic events and world events like wars or pandemics or things like that affect the stock market. So it's really great information. It has to do with market tone, and that's one of the most important components. If you go back and you listen to previous episodes, you'll see the three legs on the trading table that we talk about at TRADEway: fundamental analysis, technical analysis, market tone. That market tone is partly news and it's partly the S&P chart. So it's kind of what we're talking about here. So during a recession, that chart begins to fall down through those moving averages that I mentioned, and it gets below them and begins to downtrend. Now you have the potential to make money when the market goes down because you can buy puts. When that thing goes up and hits the 20-day moving average, for example, and bounces down, that's a good buy point for puts. And you'll find a lot of individual stocks doing the same thing. So that's kind of a neat clue. When you see yourself get into a recession or a bear market crash, make sure that you've gone out there to TRADEway and you've taken advantage of the Trader Max. That's really probably one of the best ways to take advantage of Step 2, because that's where you learn how to buy puts the right way and have potential to make money when the market's going down. All right, so the recessions usually, I won't say recession, let's just talk about bear market. It's kind of a synonym, but not exactly. I don't know if I want to get into that on this show, but let's just talk about the bear market, the downtrend. They usually last on average 6 to 9 months, all right? Now, sometimes that depends on what caused it, of course. Like this most recent one from real time right now would be the COVID situation, and the pandemic created a huge bear market crash. It fell over 35% in just a matter of days, but it recovered more quickly than any bear market crash in my lifetime, and it made a V recovery, and I've never even seen one of those in my lifetime. So that was interesting. We may talk about that on the next episode, but in general, a recession, most people like your neighbor will think no one's ever going to buy a car again, for example. They're going to think that the whole world is going to come unglued, and you're looking at it thinking, wow, I have a great opportunity because of all this potential I have to buy puts and make money on the way down. So you finally learn to not think of it as a bad market or a good market. It's just a bull or a bear. They're both good if you have the skill sets, right? That's what TRADEway is all about, is to get you those skill sets. Now, the recession, if you want to talk about the move of the market itself, it can be a little different than the actual economy. For example, The stock market looks out about a year or two in the future, usually about a little over a year into the future, and says, hey, does it look better or worse out there? And if it looks worse, then it's going to be going down. All right, but think about this. While it's heading down, let's say you've been in this down move, this downtrend for 6, maybe 9 months, the market starts looking out there a year and a half in the future and says, well, things are going to be way better than this, and it'll actually start moving up before the economy gets good. And that fools people because they don't know these skill sets. But just remember that the market anticipates the economy, so it will move up while the economy is still terrible. And then as it begins to move up, you'll see the economy come in behind it and get better. And that's kind of how you have an advantage of playing these recessions, like a bear market versus a bull market. Now, let me give you another tip on that. At the end of most bear market crashes, we will have what we call a triple bottom. It'll try to move up and then tank again, and then recover again and tank again, and then finally turn into a bull market. So watch for triple bottoms before you start putting a lot of money into up plays in what you think is the next bull. Let it make 3 bottoms. Now, this pandemic one that we'll talk about in the next episode, it only made 1 bottom, so it fooled a lot of the smartest people on Wall Street, and rightly so, because they'd never seen one like that. But it kind of goes and shows you, the past does not always predict the future, does it? So we need to understand that. But so what we're looking at is probability math. And when you do see a triple bottom at the end of a bear market crash, the probability math is better on your side that it's about to go up and start a new bull market. So that's something to know. It's kind of interesting as a side note. At the top of the end of a bull market, which actually usually lasts, a couple of years to 4 years, at the top of one of those, it will commonly make a triple top before it bounces down and starts a downtrend or a bear market crash. All right, well, that's all we have time for today, but that's some really good information that can help you with your trading. And if you liked it, why don't you rate and review our show so other like-minded people can find us? We really appreciate it, and have a great day.